There is a force in the financial universe so powerful, so fundamental, that it governs the rise and fall of entire markets. It's an invisible tether, a constant pressure that dictates the very value of every stock, every bond, every piece of real estate on the planet. Most investors, even those who have been in the market for years, are only vaguely aware of it. They feel its effects as sudden, gut-wrenching portfolio drops or euphoric, inexplicable rallies, but they don't understand the mechanism. They treat it like the weather, an uncontrollable, unpredictable act of nature. But one man, from a quiet office in Omaha, Nebraska, has not only understood this force but has built one of the world's greatest fortunes by simply respecting it. Warren Buffett gave this force a name. He called it gravity. And what he meant by that simple, elegant metaphor is the principle that will form the bedrock of our entire discussion today. The idea that interest rates act like gravity on all financial asset valuations. When interest rates are low, it's like being on the moon. Asset prices can float to astonishing, almost unbelievable heights. But when interest rates rise, it's like the gravitational pull of Jupiter, relentlessly and brutally pulling everything back down to Earth. Understanding this single principle is the key to unlocking a level of market awareness that few retail investors ever achieve. It's the difference between being a leaf tossed in the wind of market volatility and being the captain of a ship who understands the tides. Ignoring it is perhaps the single most costly mistake an investor can make. It's the mistake of getting swept up in the mania of a bull market, paying astronomical prices for exciting companies, all while the Federal Reserve is quietly signaling that it's about to increase the force of gravity. It's the mistake that leads to portfolios being cut in half, not because the companies within them suddenly became terrible, but because the entire financial environment changed. The transformation we are aiming for today is profound. By the end of this journey, you will no longer see the stock market as a random collection of upward and downward squiggles on a screen. You will see it as a complex system governed by a fundamental law. You will possess a powerful macro lens, a new way of thinking that will allow you to assess the overall risk in the market at any given time, giving you the wisdom to know when to be aggressive in pursuit of portfolio growth and when to be defensive, preserving the wealth you have worked so hard to build. This isn't about predicting the market's next move with perfect accuracy. It's about understanding the forces that make those moves happen. It's about moving from a reactive mindset to a strategic one, a journey that is essential for anyone serious about long-term investing, building wealth, and ultimately achieving financial freedom. To truly internalize this concept, we will deconstruct it into 5 fundamental pillars. First, we will establish the foundational equation of value, exploring the raw mechanics of how the world's most successful investors determine what an asset is truly worth and how interest rates are the central cog in that machine. Second, we will examine the great battle for capital, understanding how stocks are in a constant, fierce competition with the safety of bonds, a competition refereed by the Federal Reserve. Third, we will analyze the ripple effect, seeing how the gravitational pull of interest rates extends beyond market prices and directly impacts the behavior and profitability of the corporations themselves. Fourth, we will delve into the psychology of a shifting landscape, exploring the cognitive biases that blind the average investor to changes in financial gravity until it's far too late. And finally, we will uncover Buffett's defensive moat, learning how he structures his portfolio and chooses his companies to not just survive but thrive when the gravitational forces become immense. This is the path to becoming an intelligent investor, to developing a CEO mindset, even if you're a retail investor just starting your journey. This is the blueprint for understanding the final promise of the market, that while prices may fluctuate wildly, value is ultimately tethered to reality by the unbreakable law of financial gravity. Our first pillar is the most fundamental of all. It is the bedrock upon which all rational investment is built. We must understand the fundamental equation of value. Before we can talk about markets, economies, or Federal Reserve policy, we must answer a simple question: what is a business or any financial asset actually worth? The answer, as articulated by thinkers for centuries and perfected by investors like Buffett, is breathtakingly simple in its concept, yet profound in its implications. The value of any asset is the sum of all the cash it will produce from now until Judgment Day. with each of those future cash payments discounted back to its value in today's dollars. That's it. That is the core of all valuation. Whether you are buying a small local coffee shop, a share of Apple stock, or an entire apartment complex, you are buying a stream of future cash flows. And the key to this entire concept, the variable that controls everything, is that second part, the discount. How much less is $1 a year from now worth to you today? The answer to that question is dictated by interest rates. To truly grasp the power of this, we must transport ourselves back to a time of supreme market euphoria, a time when it seemed the laws of finance had been suspended. The year is 1999. The internet is booming, and the dot-com bubble is inflating to its most terrifying and magnificent proportions. Companies with no profits, no revenues, and in some cases no finished products, are seeing their stock prices double overnight. The mantra of the day is, "This time is different." Old valuation metrics are considered relics of a bygone era. It's all about eyeballs, clicks, and growth at any price. Against this backdrop of what Alan Greenspan famously called irrational exuberance, Warren Buffett writes an article for Fortune magazine that lands like a lead balloon. It is titled simply "Mr. Buffett on the Stock Market." In it, he doesn't talk about exciting new technologies or disruptive business models. He talks about something far more boring, far more fundamental: interest rates and corporate profits. Buffett starts with a simple observation. He looks at the two most important factors in his valuation equation. First, the level of corporate profits as a percentage of GDP. He notes that this figure tends to revert to a mean over time. In the late 90s, it was historically high, suggesting it was more likely to fall than to continue rising. But the second factor he highlights is the one that forms the core of our discussion: the long-term interest rate, specifically the yield on long-term government bonds. In 1999, after years of a strong economy, the yield on the 30-year U.S. Treasury bond was hovering around 6%. Buffett then lays out the argument with devastating clarity. He explains that this 6% rate is the yardstick against which every other investment must be measured. It is the risk-free rate of return. An investor in 1999 could simply buy a government bond, an asset backed by the full faith and credit of the United States government, and lock in a 6% return for 30 years. No risk, no effort. Therefore, he argued, any riskier investment like a stock must offer a prospective return significantly higher than 6% to be attractive. The problem was that stock prices had been bid up to such stratospheric levels that their future expected returns were actually far turns lower than what you could get from a simple, boring government bond. The S&P 500's earnings yield, the earnings per share divided by the share price, was plumbing historic lows below 3%. People were paying over 30 times a company's annual earnings for the privilege of owning it. In Buffett's mind, this was mathematical insanity. Why would any rational person accept a potential return of 3% from a volatile stock when they could get a guaranteed 6% from a risk-free bond? The only way to justify these stock prices was to believe in one of two things. Either corporate profits were about to explode to levels never before seen in human history and stay there forever, or interest rates were about to plummet and stay low forever. Buffett, being a student of history and a realist, found both scenarios highly unlikely. He applied his gravitational principle. With a 6% interest rate acting as a powerful gravitational force, the sky-high valuations of the stock market were unsustainable. They were like a helium balloon that had floated far too high into the atmosphere and was destined to be pulled back down. He wasn't timing the market. He was simply stating a fundamental truth. He concluded the article with a stark warning, predicting that the returns from stocks over the next decade or two would be far, far lower than what investors had grown accustomed to in the glorious bull run of the 80s and 90s. The reaction from the market was largely derision. Buffett was called a dinosaur, a man who didn't get the new economy. He was out of touch. Less than a year later, the Nasdaq Composite Index, the epicenter of the dot-com mania, began a catastrophic collapse, ultimately falling nearly 80% from its peak. Many of the high-flying companies of the era went bankrupt. The S&P 500 entered a brutal bear market and delivered essentially zero returns for the next decade, just as Buffett's dispassionate analysis of interest rates and valuations had predicted. This wasn't magic or prophecy. It was the simple, inescapable math of financial gravity, a lesson learned firsthand through one of the most dramatic market events in modern history. The reason Buffett's 1999 prediction was so accurate, and the reason so many others got it so disastrously wrong, can be explained by a powerful and pervasive psychological principle: recency bias. This cognitive bias is our brain's tendency to give greater importance to recent events than to historical ones. We are wired to extrapolate the immediate past into the indefinite future. In the context of the late 1990s, investors had experienced nearly 2 decades of one of the greatest bull markets in history. From 1982 to 1999, the stock market had delivered phenomenal, seemingly effortless returns. For an entire generation of investors and even professional money managers, this was the only reality they knew. Their brains, guided by recency bias, saw these high returns not as a historical anomaly, but as the new normal. The mental narrative became, "Stocks always go up." This bias created a dangerous feedback loop. As stock prices rose, it reinforced the belief that they would continue to rise, which encouraged more buying, which pushed prices even higher. This is the classic anatomy of a speculative bubble. Recency bias effectively short-circuits the rational part of our brain that should be performing the kind of valuation analysis Buffett was doing. Instead of asking, given a 6% risk-free rate, what is a reasonable price to pay for this stream of future earnings, the investor guided by recency bias asks, this stock went up 50% last year, so how can I get in on the next 50%? The fundamental question of value is replaced by the speculative question of price momentum. Furthermore, this is compounded by another powerful bias, the overconfidence bias. As investors made money easily in the rising market, they began to attribute their success to their own skill and intelligence, rather than to the simple fact that they were in a massive, market-wide updraft. They felt like geniuses. This overconfidence made them deaf to cautionary voices like Buffett's. Why would they listen to an old man from Omaha talking about boring things like interest rates, when their own brilliant strategy of buying any .com stock was making them rich? This combination is lethal. Recency bias convinces you that the current trend will last forever, and overconfidence bias convinces you that you are smart enough to ride that trend and get out just before it breaks. It creates a state of willful blindness to the changing fundamentals. The Federal Reserve had been gradually raising interest rates throughout the late 90s to cool the overheating economy. The gravity was demonstrably increasing. The yield on the 10-year Treasury had risen from under 4.5% to over 6.5%. Yet the market, drunk on its own recent success, ignored these clear signals. It's like a pilot flying a plane higher and higher, celebrating their ascent, while completely ignoring the instruments telling them that the air is getting thinner and their engines are losing power. Buffett, by contrast, operates with a system that forces him to override these biases. His focus on the discount rate is a cerebral, analytical process. It forces him to look at the objective data, the level of interest rates, rather than the subjective feeling of market euphoria. His mental model is not based on what has the market done lately, but on what is the mathematical value of this asset given the current price of money. This disciplined, unemotional approach is what allowed him to see the cliff's edge while everyone else was still admiring the view from the top. He wasn't immune to the psychological pull of the herd. He simply had a stronger, more rational framework that anchored him to reality, protecting him and his investors from the devastating crash that followed. Understanding financial gravity is, at its core, a psychological tool for fighting our own brain's worst tendencies. So how can we, as individual investors, translate this powerful principle into a practical, repeatable process? We need an applied mental model, a blueprint that we can use to immunize ourselves from the euphoria of low-rate bubbles and the terror of high-rate busts. Let's call it the valuation gravity check. This isn't about becoming a certified financial analyst or building complex discounted cash flow models in Excel. It's about developing an intuitive, back-of-the-envelope feel for how changes in interest rates affect the value of what you own. It consists of 4 simple steps. Step 1. Always know the current risk-free rate. This is your gravitational constant. The easiest and most common proxy for this is the yield on the U.S. 10-year Treasury note. You should know this number, just as you know the price of a gallon of gas. Is it 1%, 3%, 5%? This single number provides more context about the overall investment environment than hours of watching financial news. When this number is extremely low, say below 2%, you know that the gravitational pull on asset prices is weak. Valuations can stretch and float higher. When this number is high, say above 4% or 5%, you know that gravity is strong. There is a powerful force pulling down on all asset valuations, and a much higher bar for any investment to be considered attractive. Make it a habit to check this rate weekly. This simple act anchors your entire financial worldview to reality. Step 2. For any investment you are considering, whether it's an individual stock or the entire market, try to frame its value in terms of future cash. Let's take a simple example. Imagine a great, stable company that you believe will generate $1 of free cash flow per share, per year, forever. For simplicity, let's say this cash flow doesn't grow. Now, let's apply our gravity check. In a world where the 10-year Treasury yield, our risk-free rate, is 2%, what is that stock worth? An investor needs a return greater than the risk-free rate to justify owning the stock. Let's say they demand a 5% earnings yield. To get $1 a year at a 5% yield, you would pay $20 for that share. The math is simple. $1 divided by 5% or 0.05 equals $20. Step 3. Now, run the high-gravity scenario. Imagine the Federal Reserve has been fighting inflation, and the 10-year Treasury yield has risen to 5%. This is now our new baseline. An investor can get 5% risk-free from the government. Why would they buy your stock for the same 5% yield? They wouldn't. They would demand a higher return to compensate for the additional risk of owning a business. Let's say they now demand an 8% earnings yield. What happens to the value of your stock, which still produces that same steady $1 of cash flow per share? The math changes. $1 divided by 8% or 0.08 equals $12.50. The intrinsic value of the business has collapsed from $20 to $12.50, a drop of nearly 40%. Nothing about the company changed. It's still a great business generating the same amount of cash. But the entire financial environment changed. The force of gravity increased, and the valuation was ruthlessly pulled down. Step 4. Internalize the concept of duration. This is a term borrowed from the bond market, but it's incredibly useful for stocks. Long-duration assets are those whose value is derived from cash flows expected far out in the future. Think of a pre-profit, high-growth tech startup. Its value today is based entirely on the hope of massive profits 10 or 15 years from now. Short-duration assets are those whose value is derived from cash flows being generated right now or in the very near future. Think of a stable, dividend-paying utility company. When interest rates rise, long-duration assets get hit the hardest. Those distant cash flows are discounted much more heavily, and their present value collapses. This is exactly what we saw in 2022. The most speculative, unprofitable tech stocks fell 80 to 90%, while boring, profitable value stocks held up much better. By using the valuation gravity check, you start to see your portfolio not just as a collection of company names, but as a basket of assets with varying sensitivities to the force of financial gravity. This mental model provides a powerful framework for asset allocation and risk management, transforming you from a passive price taker to a strategic, environment-aware investor. To fully appreciate the wisdom of Buffett's approach, we must dedicate some time to exploring its opposite. We must walk the path of the 99%, the path that consistently leads to financial disappointment and, in many cases, ruin. This is the path of ignoring financial gravity and instead focusing exclusively on narrative and price momentum. The core mistake, the antithesis of the valuation gravity check, is the growth at any price fallacy. This philosophy takes hold during periods of low interest rates, when weak gravity allows for speculative narratives to flourish. The thinking goes like this. If a company is growing its revenues at an astronomical rate, 50%, 100%, or even 200% per year, then its current valuation doesn't matter. Any price is justifiable because the future growth will be so immense that it will eventually validate even the most eye-watering multiples. This was the dominant mindset of the dot-com bubble. Investors chased companies like Pets.com or Webvan, not because they had a clear path to profitability or a sustainable business model, but because their revenues were growing and they were associated with the revolutionary narrative of the Internet. The question of what are the discounted future cash flows was replaced with, how much is someone else going to be willing to pay me for this stock next week? It is a philosophy of pure speculation, masquerading as a sophisticated investment strategy. We saw a powerful echo of this in the 2020-2021 market environment. With the Federal Reserve holding interest rates at zero and pumping trillions of dollars into the financial system, gravity was effectively switched off. This created a paradise for growth at any price investors. They poured money into electric vehicle companies that had yet to produce a car, into software companies with massive losses but fast-growing user bases, and into cryptocurrencies with compelling stories but no underlying cash flows. The consequences were predictable for anyone armed with Buffett's principle of gravity. Take, for example, a popular high-growth tech stock that, at its peak in late 2021, traded at over 30 times its annual revenue. Not 30 times profit. The company was losing hundreds of millions of dollars. 30 times sales. At the time, with interest rates near zero, this seemed plausible to many. The justification was that in 10 years, the company would dominate its industry and generate enormous profits. Those distant profits, when discounted back to the present by a near-zero interest rate, could be used to justify the massive valuation. But then, reality reasserted itself. Inflation surged, and the Federal Reserve began the most aggressive rate-hiking cycle in 4 decades. The 10-year Treasury yield, our gravitational constant, shot up from under 1% to over 4%. What happened to that high-flying stock? Its price collapsed by over 80%. The company's story didn't necessarily get worse. It was still growing, still innovating. But the math of its valuation was completely shattered. Those hypothetical profits a decade in the future were now being discounted by a much, much higher rate. Their present value evaporated. The 99% who bought near the top were left holding the bag, their dreams of financial freedom shattered, all because they focused on the exciting story and ignored the boring, but all-important, change in the financial environment. This path is seductive because it feels exciting and modern. It aligns with our natural desire for stories of disruption and exponential growth. The slow, methodical work of discounting future cash flows feels archaic by comparison. But financial history is a graveyard of investors who believed this time is different. The names of the speculative assets change, from Dutch tulips to British railway stocks to dot-coms to 2021's tech darlings. But the underlying mistake remains the same. A profound disrespect for the immutable law of financial gravity. The impact of this principle isn't just a theoretical exercise. It has a direct, measurable, and often brutal connection to the numbers on a balance sheet, the performance of an investment portfolio, and the very strategic decisions made in corporate boardrooms. Understanding this financial connection is what separates amateur speculation from professional wealth management. Let's start with the investment portfolio. An investor who ignores interest rate gravity will find their portfolio's performance is erratic and terrifyingly vulnerable to macroeconomic shifts they don't understand. During the zero interest rate period of the 2010s, a portfolio heavily concentrated in what was called long-duration growth stocks, unprofitable tech companies whose entire valuation rested on distant future earnings, likely performed spectacularly. This would have reinforced the investors' belief in their own stock-picking genius. However, this performance was not a result of skill, but of a specific environmental condition, the absence of gravity. When the Federal Reserve began its tightening cycle in 2022, that same portfolio would have experienced a catastrophic decline. We're talking about losses of 50, 60, even 70%. The investor's statement would be a sea of red. This is a direct financial consequence. The net asset value of their holdings plummeted, not because their companies failed, but because the discount rate applied to their future earnings skyrocketed. Conversely, a portfolio built with an awareness of financial gravity, like that of Berkshire Hathaway, would look very different. It would be weighted towards businesses with strong, immediate cash flows, low debt, and pricing power, what we might call short duration or all-weather equities. Think of companies like Coca-Cola or See's Candies. Their value is based on the profits they are making today. While their stock prices would also be affected by a rise in rates, the impact would be far more muted. Their tangible, present-day earnings provide a solid floor under their valuation. This difference in portfolio construction, guided entirely by an understanding of interest rates, is the difference between building sustainable, long-term wealth and riding a speculative roller coaster that often ends in a crash. It is the core of intelligent asset allocation. Now let's look at the corporate level. A CEO or entrepreneur operating with a CEO mindset must also be a student of financial gravity. When interest rates are low, capital is cheap. It's a time for aggressive expansion. Companies can borrow money for next to nothing to fund research and development, build new factories, or acquire competitors. This fuels growth and can lead to significant capital gains for shareholders. However, a CEO who assumes cheap capital will last forever is making a grave error. They might load up the company's balance sheet with massive amounts of debt to fund speculative projects. When interest rates inevitably rise, this becomes an anchor that can sink the entire enterprise. Suddenly, the interest expense on that debt explodes, eating into profits. Refinancing that debt becomes prohibitively expensive. A project that looked profitable with a 2% cost of capital becomes a money-losing disaster with a 7% cost of capital. This is how rising rates can trigger waves of bankruptcies among over-leveraged companies. The financially astute CEO, the one who understands gravity, uses periods of low rates wisely but maintains a fortress balance sheet. They know that a strong financial position with low debt is a massive competitive advantage when rates rise and their more reckless competitors begin to struggle. This is a core tenet of the Warren Buffett strategy: focus on businesses that don't rely on cheap leverage to generate returns. This direct financial connection, from the discount rate in a valuation model to the asset allocation in a portfolio to the debt load on a corporate balance sheet, demonstrates that the principle of financial gravity isn't an abstract economic theory. It is the most practical, powerful, and financially significant force an investor or business leader can ever hope to understand. We have established the fundamental law: interest rates act as gravity on valuations. Now, we must move to our second pillar and explore where this force comes from and how it manifests in the real world. This is the great battle for capital, the constant, titanic struggle between stocks and bonds for the trillions of dollars flowing through the global financial system. To truly understand the stock market, you must understand that it does not exist in a vacuum. It is part of a larger ecosystem of investments, and its chief competitor, its eternal rival, is the bond market. Every dollar of investment capital in the world faces a choice, and at its most basic level, that choice is between the potential growth of an equity, a stock, and the contractual safety of a debt instrument, a bond. The referee in this epic battle, the one who sets the terms of engagement, is the central bank, in the United States, the Federal Reserve. To illustrate this dynamic, we must travel back to the early 1980s, a period that represents the polar opposite of the dot-com bubble. It was a time of crushing interest rates and profound pessimism. Following the high inflation of the 1970s, the Federal Reserve, under Chairman Paul Volcker, embarked on a ruthless campaign to break the back of inflation. He did this by hiking the federal funds rate to unprecedented levels, at one point peaking over 20%. This had a dramatic effect on the entire bond market. The yield on a safe, boring 10-year U.S. Treasury bond surged into the double digits, exceeding 15% in 1981. Now, stop and truly consider the implications of that number. An investor in 1981 could give their money to the U.S. government, the safest credit in the world, and receive a guaranteed 15% return every single year for a decade. You could double your money in less than 5 years with absolutely zero risk of default. This is the context for one of Warren Buffett's most famous and, at the time, contrarian investment periods. While the rest of the world was terrified of stocks, convinced that the economy was in a permanent state of stagflation, Buffett was quietly and aggressively buying. He famously invested a significant portion of Berkshire Hathaway's insurance portfolio in the Washington Public Power Supply System, or WPPSS bonds, which were yielding an astonishing 17%. But he was also buying stocks, most notably making a huge investment in the Washington Post Company. To the outside world, this looked insane. The economy was in recession, unemployment was high, and corporate profits were weak. Stock prices were in the doldrums. The Dow Jones Industrial Average had gone virtually nowhere for 15 years. Why would anyone buy a risky stock when you could get 15% from a safe bond? Buffett's logic was a perfect application of our second pillar. He saw the battle for capital and realized that stocks had been so thoroughly beaten down that they were now offering a far superior value proposition, even when compared to those incredibly high bond yields. He looked at a company like the Washington Post, a dominant media franchise with a near monopoly in its market, and calculated its earnings yield. This is the inverse of the price-to-earnings or PE ratio. If a stock trades at a PE of 5, its earnings yield is 20%, 1 divided by 5. Buffett saw that he could buy shares in world-class, competitively advantaged businesses at PE ratios of 4 or 5. This meant he was effectively buying a stream of corporate earnings that offered a potential return of 20% or more. The battle for capital was clear in his mind. Option A, a 15% guaranteed return from a government bond. Option B, a 20% plus potential return from owning a piece of one of the best businesses in America, a business that could also grow its earnings over time and provide protection against future inflation. For Buffett, the choice was obvious. The intense gravitational pull of Volcker's high interest rates had compressed stock valuations to such a ridiculous degree that they had become coiled springs, ready to explode upwards. The pessimism of the market, the herd's flight to the safety of bonds, had created the single greatest stock buying opportunity in a generation. And what happened? As the Fed's policies eventually tamed inflation and interest rates began their long, multi-decade decline, the force of gravity weakened. Money began to flow out of the bond market, where yields were now falling, and into the stock market. The coiled spring was released. This shift in the battle for capital ignited the great bull market that began in 1982 and, with a few interruptions, ran for the rest of the century. Buffett's courage to buy stocks when they were hated, precisely because the alternative of bonds was so attractive, laid the foundation for Berkshire Hathaway's legendary performance. He understood that the price of stocks is always relative to the price of bonds. The psychological forces at play during this battle for capital are incredibly powerful and often lead the average investor to do the exact wrong thing at the exact wrong time. The primary cognitive bias at work here is loss aversion, a principle first identified by psychologists Daniel Kahneman and Amos Tversky. Loss aversion is the human tendency to feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain. This emotional asymmetry has profound implications for investment decisions. In the high-rate environment of the early 1980s, investors had just lived through the brutal, wealth-destroying stagflation of the 1970s. Their portfolios had been battered, The emotional scars were deep. Their brains, hypersensitive to the possibility of further losses, saw stocks as instruments of pain. The very idea of buying a stock, a volatile asset that could go down, was terrifying. Simultaneously, the bond market was offering something incredibly seductive to a loss-averse brain: certainty. The 15% yield on a treasury bond wasn't a potential return. It was a contractual guarantee. It was the financial equivalent of a safe harbor in a raging storm. The emotional comfort of that guaranteed return was immense. It promised an end to the pain and uncertainty. This created a massive psychological gravity well, pulling capital and investor sentiment towards the safety of bonds, regardless of the underlying valuation of stocks. This is where herd mentality or social proof comes in. When everyone around you is panicking about the economy and celebrating the safety and high yields of bonds, it is incredibly difficult to stand apart. The social pressure to conform is immense. Selling stocks and buying bonds felt like the smart, prudent, and socially validated thing to do. Buying stocks, as Buffett was doing, felt reckless and foolish. You were going against the entire crowd, which is a psychologically uncomfortable and isolating experience. Buffett's genius lies in his ability to emotionally detach from this herd behavior. His decision-making framework is not based on what feels safe or what everyone else is doing. It is based on a rational comparison of prospective returns. He uses the high yield on bonds not as a reason to be scared of stocks, but as a benchmark, a hurdle rate, that any stock investment must clear. He is essentially asking, can this business I'm buying provide a better long-term return than the 15% I can get from this bond? If the answer is yes, he buys, irrespective of the prevailing fear and gloom. He is able to invert the common psychological reaction. For the 99%, high interest rates are a signal of danger and a reason to sell stocks. For Buffett, they are the very force that creates the bargains, compressing stock valuations to a point where their prospective returns become irresistible. He is not immune to feelings of fear or the pain of loss, but his analytical framework is stronger than his emotional impulses. He has trained himself to be greedy when others are fearful, a maxim that is easy to say but incredibly difficult to practice. This psychological discipline, this ability to act as a rational counter-cyclical force against the emotional tides of loss aversion and herd mentality, is the true source of his outsized returns. It allows him to win the battle for capital by buying what the fearful masses are desperately selling. To operationalize this understanding of the battle for capital, we need another mental model. Let's call this one the hurdle rate compass. This model helps you orient your investment decisions not in a vacuum, but in the context of the ever-present alternative of the bond market. It's a way to ensure you're always being compensated for the risks you're taking. There are 3 steps to using this compass. Step 1. Establish your risk-free benchmark. Just like in our first model, this starts with the 10-year Treasury yield. This is your baseline, your North Star. Let's say today the 10-year yield is 4%. This means you can earn a 4% annual return with virtually no risk. This 4% becomes the absolute minimum return you should consider for any other investment. It is your first hurdle. Why would you risk your capital in the volatile stock market for a potential return of only 3% or 4%? The answer is, you wouldn't. This immediately helps you filter out a huge number of poor investment choices. Step 2. Calculate the equity risk premium you demand. The equity risk premium, ERP, is a fancy term for a simple concept. How much extra churn above the risk-free rate do you need to be paid to convince you to take the risk of owning stocks? This is a personal decision, but historically, this premium has averaged around 4% to 6%. So, if the risk-free rate is 4% and you demand a 5% equity risk premium, your total required rate of return, your hurdle rate, for an investment in the stock market is 9%, 4% plus 5%. This 9% figure now becomes your primary decision-making tool. Any stock you buy, or even the market as a whole, must offer you a credible path to earning at least a 9% annualized return. Step 3. Evaluate investments against your hurdle rate. Now you can apply this to real-world decisions. Let's look at the S&P 500. You can find its current earnings yield online. Let's say the P/E ratio of the S&P 500 is 20. The earnings yield is the inverse of that, which is 1 divided by 20 or 5%. Right away, your hurdle rate compass is flashing a warning sign. The market is offering you a starting earnings yield of 5%, but your required hurdle rate is 9%. This suggests that the overall market is expensive. The compensation you are being offered for taking on equity risk is not sufficient compared to the safe alternative of bonds. This doesn't mean you should sell everything and hide in cash, but it does mean you should be more cautious, more selective, and perhaps hold more cash or bonds than you would if the earnings yield were, say, 10%. You can apply the same logic to an individual stock. If you are analyzing a company and, after your stock analysis, you conclude that your most realistic estimate of its long-term annual return is 7%, you should pass on the investment. It does not clear your 9% hurdle rate. You would be better off buying the S&P 500 index or even just the 10-year Treasury bond. This compass forces you to be disciplined. It stops you from falling in love with a company's story and forces you to ask the cold, hard question: is this investment going to pay me enough to justify the risk, given my other options? It's a simple but profoundly effective way to manage risk and improve your long-term portfolio growth. The antithesis to using the hurdle rate compass is a pervasive and dangerous mindset we can call TINA, which stands for "there is no alternative." This was the dominant narrative for much of the 2010s, during the period of historically low and even zero interest rates following the 2008 financial crisis. The Federal Reserve kept rates pinned to the floor in an attempt to stimulate the economy. The yield on the 10-year Treasury bond fell to below 2% and at times even approached 1%. The battle for capital became incredibly one-sided. Bonds offered virtually no return. A 1.5% yield on a government bond doesn't even keep up with inflation. Investing in it meant you were guaranteeing a loss of purchasing power over time. In this environment, the TINA narrative took hold. The argument was simple: because bonds and cash yield nothing, you have to be in the stock market. There is no alternative if you want to generate any kind of return. This philosophy led to a massive, indiscriminate flood of capital into the stock market. Valuations, unanchored by a credible bond yield competitor, floated to extreme highs. The hurdle rate compass was effectively broken because the risk-free rate was so low. If the risk-free rate is 1% and you demand a 5% equity risk premium, your hurdle rate is only 6%. An earnings yield of 4%, corresponding to a P/E of 25, while historically expensive, looks much more reasonable when the alternative is a 1% bond. The TINA mindset encourages complacency and a suspension of critical valuation work. Investors stopped asking if stocks were cheap or expensive in an absolute sense, and simply bought them because they were the quote, only game in town. It fostered a belief that the Federal Reserve would always keep rates low to support the market, a concept known as the Fed put. This created enormous moral hazard, encouraging investors to take on more and more risk, believing they were shielded from the consequences. The disastrous consequences of this path became apparent in 2022 when inflation forced the Federal Reserve to abruptly end the era of easy money. Interest rates rose at the fastest pace in modern history. Suddenly there too was an alternative. The yield on a 2-year Treasury note shot up to over 5%. Safe, short-term government bonds were now offering a higher yield than the S&P 500's earnings yield. The entire foundation of the TINA argument crumbled overnight. The battle for capital, which had been a blowout victory for stocks for over a decade, suddenly became a fair fight. Capital began to flood out of the stock market and into the newly attractive bond market. The S&P 500 fell over 20%. And the tech-heavy NASDAQ fell over 30%. Investors who had been lulled into complacency by the TINA narrative, who had believed there was no alternative, discovered that an alternative had emerged with a vengeance, and the rebalancing of capital between the two asset classes was swift and brutal. The 99% who followed the TINA path learned a painful lesson. There is always an alternative. The relationship between stocks and bonds is a permanent law of finance, and assuming it has been suspended is one of the most reliable ways to destroy your own wealth. The financial connection of this battle for capital is written in the flow of trillions of dollars across global markets. It is the primary driver of bull and bear markets and has a tangible impact on everything from retirement account balances to the availability of venture capital for entrepreneurs. Let's quantify this. In a high-rate environment like the early 1980s, money market funds and certificates of deposit (CDs) offered yields in the double digits. A retiree could park their life savings in a completely safe instrument and generate enough income to live on. There was very little financial incentive for them to risk their principal in the stock market. This starves the equity market of capital. It leads to lower stock prices and lower PE multiples as the marginal buyer, the one who sets the price, is content with the high yields available in the bond market. For a financial advisor practicing wealth management during this period, a heavy allocation to bonds and cash was not only prudent, it was lucrative for their clients. Now consider the low-rate TINA environment of the 2010s. With money market funds paying 0.1% and 10-year bonds paying 1.5%, the situation is reversed. The same retiree now finds that their safe investments generate virtually no income. To avoid depleting their principal, they are forced to move their money into riskier assets in a phenomenon known as reaching for yield. They sell their safe bonds and buy dividend-paying stocks, real estate investment trusts, REITs, or even high-yield corporate bonds. This massive, forced migration of capital out of the safety of the bond market and into the risk of the stock market creates a powerful, sustained tailwind for stock prices. PE multiples expand, not necessarily because corporate earnings are exploding, but because there is a wall of money with nowhere else to go. This is a direct financial transfer. The Federal Reserve's policy, by manipulating the risk-free rate, effectively herds investors from one asset class to another. This has huge implications for asset allocation. An intelligent investor who understands this dynamic adjusts their portfolio strategy based on the state of the battle. When bond yields are high and attractive, signaling that stocks are likely cheap and hated, as in 1982, it's a time to be aggressive with your stock market for beginners strategy, increasing your allocation to equities to take advantage of the depressed valuations. When bond yields are pitifully low and the TINA narrative is dominant, as in 2021, it signals that stocks are likely expensive and crowded. This is a time for caution. It's a time to perhaps trim some of your biggest winners, increase your cash position, and reduce your overall risk exposure. You are preparing for the inevitable day when gravity returns. This isn't market timing in the traditional sense of predicting short-term moves. It's strategic, long-term asset allocation based on the relative valuation between the two most important asset classes on Earth. Failing to understand this dynamic means you are perpetually reacting to the market's whims. Understanding it allows you to anticipate the great shifts in capital flows, positioning your portfolio to benefit from them rather than be crushed by them, a crucial step on the path to financial independence. We have seen how interest rates act as a valuation gravity and how they dictate the battle for capital between stocks and bonds. Now, for our third pillar, we must go deeper, beyond the financial markets and into the very sinews of the real economy. We will explore the ripple effect, how interest rates directly impact the behavior, profitability, and strategic decisions of the companies themselves. This is a critical piece of the puzzle, because the ultimate source of all stock market value is the earnings generated by real businesses. If rising rates harm the ability of those businesses to generate profits, that damage will inevitably be reflected in their stock prices, creating a secondary and powerful gravitational drag. To witness this ripple effect in action, we need only look at one of the most interest rate-sensitive sectors of the economy, housing and construction. The story of the great housing bubble of the mid-2000s and its subsequent collapse is a perfect case study. In the early 2000s, following the dot-com bust and the 9/11 attacks, the Federal Reserve, under Chairman Alan Greenspan, cut interest rates dramatically to stimulate the economy. The federal funds rate was lowered to a then-historic low of 1%. This had a massive and immediate impact on mortgage rates. Suddenly, the cost of borrowing to buy a house plummeted. 30-year fixed-rate mortgages became available for 5% or even less. This cheap money ignited a firestorm of activity in the housing market. For a company like Pulta Group or D.R. Horton, two of the nation's largest home builders, this was a golden age. The low rates created a surge in demand for new homes. People who previously couldn't afford a house were now able to qualify for loans. Existing homeowners refinanced to extract equity from their rising home values, often using the cash for home improvements or other consumption. This created a virtuous cycle for the builders. Their sales volumes exploded. They could sell homes as fast as they could build them. And because demand was so strong, they could also raise prices aggressively, leading to soaring profit margins. Their balance sheets and income statements looked incredible. Revenues and profits grew at double-digit rates year after year. Their stock prices went parabolic. An investment in a homebuilder stock in 2002 would have generated life-changing returns by 2005. However, this entire boom was built on the foundation of artificially low interest rates. The ripple effect was clear. Low Fed rates led to low mortgage rates, which led to surging housing demand, which led to record profits for homebuilders. But Warren Buffett has a famous saying, "It's only when the tide goes out that you discover who's been swimming naked." The tide, in this case, was the Federal Reserve. Starting in mid-2004, the Fed began to worry about inflation and the speculative froth in the housing market. They began a slow but steady series of interest rate hikes, taking the federal funds rate from 1% all the way to 5.25% by mid-2006. The ripple effect now worked in reverse, with devastating consequences. Each hike by the Fed put upward pressure on mortgage rates. That 5% mortgage of 2003 became a 6.5% mortgage by 2006. This might not sound like a huge difference, but for a family buying a home, it's enormous. On a $300,000 loan, the monthly payment would jump by hundreds of dollars. This increase in the cost of borrowing began to choke off demand. Potential buyers were priced out of the market. The flood of customers at homebuilder sales offices slowed to a trickle. Worse, many of the exotic adjustable-rate mortgages that had been popular during the boom began to reset at much higher rates, causing a wave of defaults and foreclosures. The homebuilders were hit by a perfect storm. Their sales volume collapsed. To move their growing inventory of unsold homes, they were forced to slash prices, which crushed their profit margins. The record profits of 2005 turned into catastrophic losses by 2007. Companies that had been celebrated as growth champions were now fighting for survival. Their stock prices collapsed, with most falling over 90% from their peaks. They had been swimming naked, their entire business model exposed as being completely dependent on the temporary condition of cheap money. This anecdote is a stark reminder that the impact of the Federal Reserve's decisions extends far beyond Wall Street, rippling through the real economy and fundamentally altering the profitability of entire industries. The psychological trap that ensnares so many investors and even corporate executives during these cycles is the fallacy of composition. This is the error of assuming that what is true for one part of a system must be true for the whole. In the context of the housing bubble, an individual homebuyer making a decision in 2005 looked at their personal situation. With their good job and the low monthly payment on an interest-only loan, buying that bigger house seemed like a rational, prudent decision. A single homebuilder, seeing the massive demand, decided it was rational to buy more land and ramp up construction. A single mortgage broker, seeing the opportunity to earn commissions, decided it was rational to write as many loans as possible. Each individual actor, looking only at their small piece of the puzzle, was making what appeared to be a logical choice. The fallacy occurs because they failed to see that millions of other people were making the same rational decision at the same time, all driven by the same underlying stimulus of cheap money. The collective result of all these individually rational decisions was a system-wide, completely irrational speculative mania. The crucial missing piece of their mental model was the role of the Federal Reserve. They saw the effect, the housing boom, but they didn't appreciate the cause, the artificially low interest rates. This is a form of system neglect where we focus on the visible actors, buyers, sellers, builders, and ignore the invisible rules and conditions that govern the entire system, monetary policy. This is exacerbated by confirmation bias. As home prices kept rising, it confirmed everyone's belief that they were making the right decision. Every news article about the real estate boom, every story of a neighbor flipping a house for a huge profit, reinforced the narrative. It became very difficult to process any disconfirming evidence, such as the warnings from a few economists or the fact that the Fed had begun raising rates. The brain actively filters out information that contradicts its established beliefs. The CEO of a home building company, surrounded by executives and analysts who were all benefiting from the boom, would find it nearly impossible to entertain the notion that their success was a temporary illusion created by the Fed. Doing so would be deeply uncomfortable and socially isolating. Buffett's way of thinking provides an antidote to this. His insistence on understanding the entire system, including the role of government and central banks, prevents him from falling for the fallacy of composition. He doesn't just analyze the company. He analyzes the environment in which the company operates. He would have looked at the home builders in 2005 and seen that their record profits were not the result of a sustainable competitive advantage, but rather a direct subsidy from Alan Greenspan's monetary policy. He would have recognized these profits as low quality and transient. This systems-level thinking, this ability to zoom out and see the invisible forces governing the playing field, is what protects him from getting swept up in industry-specific manias. He understands that a rising tide of cheap money lifts all boats, even the leaky ones, and he's more interested in finding the boats that can stay afloat after the tide goes out. To avoid being caught in this ripple effect, we need a mental model that helps us assess how a business will perform under different interest rate regimes. Let's call this the corporate stress test. This is a set of questions you should ask about any company you are considering for a long-term investment, designed to reveal its sensitivity to financial gravity. Question 1. How much debt is on the balance sheet? This is the most direct and important question. A company with a huge amount of debt is acutely vulnerable to rising interest rates. You need to look at the balance sheet and find the total debt figure. Compare it to the company's equity, the book value, and its annual earnings or cash flow. A company with debt that is many multiples of its annual cash flow is carrying a lot of risk. When rates rise, its interest expense will increase, directly reducing its net income. Worse, if it needs to refinance that debt, it may be forced to do so at a much higher rate, potentially turning a profitable company into an unprofitable one. Look for companies with fortress balance sheets, low debt, or even a net cash position. These are the companies that can survive and even thrive in a high-rate world, perhaps by acquiring their over-leveraged competitors who fall into distress. Question 2. Are the company's revenues cyclical or defensive? Cyclical companies sell products or services that customers buy when they feel prosperous, but cut back on during a recession. Think of auto manufacturers, luxury goods brands, and, as we've seen, home builders. These industries are often hit hard when the Fed raises rates to slow down the economy. Defensive companies sell products or services that people need regardless of the economic climate. Think of consumer staples like toothpaste and toilet paper, utilities providing electricity, or essential healthcare services. These businesses tend to have much more stable revenues and are less affected by the economic cycle that rising rates can trigger. A portfolio with a good mix of defensive businesses is better prepared to weather the storm of a Fed tightening cycle. Question 3. Does the company have pricing power? Pricing power is a term Buffett uses frequently. It means the ability of a company to raise its prices to offset rising costs without losing customers to a competitor. A company with a strong brand, a unique product, or a dominant market position, what Buffett calls a moat, has pricing power. A company that sells a commoditized product with many competitors has none. In an inflationary environment, which is often the reason the Fed raises rates in the first place, pricing power is absolutely critical. A company like Coca-Cola can raise the price of a can of Coke by a few cents to cover its higher costs for aluminum and sugar, and people will still buy it. A small, generic soda company that tries to do the same will likely see its customers switch to a cheaper alternative. Businesses with pricing power can protect their profit margins during inflationary times, making them far more resilient investments. By running every potential investment through this 3-question corporate stress test, you shift your perspective. You stop focusing only on the exciting growth story and start thinking like a risk manager. You begin to differentiate between companies that are merely benefiting from a temporary easy money environment and those that have durable, all-weather business models. This is a core discipline of the intelligent investor and a key to building a truly resilient portfolio. The opposite of conducting a corporate stress test is to engage in what we can call first-level thinking. This is a concept popularized by investor Howard Marks. First-level thinking is simplistic and superficial. Second-level thinking is deep, complex, and contrarian. The 99% of investors who fall victim to the ripple effect are stuck in first-level thinking. A first-level thinker looks at a homebuilder stock in 2005 and says, "The company's earnings are growing fast, so the stock will go up. I should buy." It's a simple, linear extrapolation. They see the effect, rising profits, and assume it will continue. A second-level thinker, applying our corporate stress test, goes deeper. They say, yes, the earnings are growing fast. But why are they growing? They are growing because historically low mortgage rates are pulling demand forward and allowing the company to charge high prices. This is a direct result of Federal Reserve policy. The Fed has already started raising rates to combat the resulting inflation and speculative bubble. As rates continue to rise, mortgage rates will follow, which will reduce demand and force the company to cut prices. This will cause earnings to fall, and the stock price will collapse. Therefore, even though the company looks good today, it is actually a very risky investment. I should sell or avoid it. This failure to engage in second-level thinking is rampant in financial markets. We saw it again in 2021 with the boom in pandemic stocks. Companies involved in e-commerce, video conferencing, and at-home fitness saw their revenues explode as the world went into lockdown. First-level thinkers extrapolated this growth rate into the future, paying enormous multiples for these stocks. They failed to ask the second-level questions. Is this demand sustainable, or is it a one-time pull forward? What will happen when the world reopens? What is the effect of the massive government stimulus that is funding this consumption? And what happens when that stimulus ends? What happens when the Fed has to raise rates to fight the inflation caused by that stimulus? The consequences were, once again, predictable and disastrous. As the world returned to normal and monetary policy tightened, these pandemic darlings saw their growth rates plummet. Their stock prices collapsed, in many cases falling more than the homebuilders did in 2008. The path of the 99% is paved with the wreckage of first-level thinking. It's the path of chasing shiny objects and recent performance without ever asking the deeper, more critical questions about the sustainability of that performance and its dependence on the macroeconomic environment. It's an approach that guarantees you will always be surprised by the turn of the cycle, buying at the top when the story is brightest and selling at the bottom when the pain is most acute. True financial education is about learning to reject this superficial analysis and embrace the more rigorous, questioning mindset of the second-level thinker. The direct financial connection of this ripple effect is stark and can be seen clearly on a company's financial statements. A company's success is ultimately measured by its ability to generate profit, and interest rates are a powerful lever on corporate profitability. Let's trace the path of a rate hike through a hypothetical company's income statement. First, the top line, revenue. If the company is in a cyclical industry like autos, a Fed rate hike designed to slow the economy will lead to fewer customers and lower sales. Revenue growth slows, stagnates, or even turns negative. Second, the cost of goods sold. Many companies use short-term financing to purchase inventory. As rates rise, the cost of this financing goes up, which can squeeze gross margins. But the most direct impact is on the line item called interest expense. A company that has funded its operations with a lot of floating rate debt will see this expense rise automatically with every Fed hike. This is a direct reduction of pre-tax profit. For a highly leveraged company, a 3% or 4% increase in its borrowing costs can be the difference between profitability and bankruptcy. Finally, this all flows down to the bottom line, net income. Lower revenue, squeezed gross margins, and higher interest expense all combine to crush net income. And since a stock's value is fundamentally a multiple of its earnings, a collapse in earnings leads directly to a collapse in the stock price. This creates a powerful feedback loop. A falling stock price makes it more difficult for the company to raise new equity capital. A deteriorating business outlook can lead to a credit downgrade, which further increases the company's borrowing costs. This is how the ripple effect can become a death spiral for a weak, over-leveraged business. For an entrepreneur or a CEO, navigating this is the essence of executive decision-making. A CEO with a deep understanding of this dynamic will be far more conservative with debt during the good times. They will prioritize building a resilient business model over chasing short-term growth funded by cheap leverage. This financial prudence may cause their stock to underperform during the speculative, low-rate phase of the cycle, but it will ensure the company's survival and even allow it to gain market share during the inevitable downturn. This is the essence of long-term value creation and a hallmark of the CEO mindset that Buffett admires. Understanding this direct financial connection transforms your analysis of a company from a simple review of past performance to a forward-looking assessment of its resilience in the face of a changing economic climate. We now arrive at our fourth pillar, which moves from the mechanical to the emotional. We have seen how interest rates impact valuations, capital flows, and corporate profits. Now we must ask why the majority of market participants seem to ignore these powerful forces until it is far too late. The answer lies in the psychology of a shifting landscape. The market is not just a collection of numbers and charts. It is a massive, complex system of human minds, and those minds are riddled with cognitive biases that are amplified in a crowd. Understanding these psychological pitfalls is just as important as understanding the math of a discounted cash flow model. To truly appreciate this, we must return to the period leading up to the 2008 global financial crisis. The Federal Reserve, as we discussed, had been raising interest rates from 2004 to 2006. The gravitational force was clearly increasing. The data showed that housing prices were beginning to flatten and then fall in some markets as early as 2006. Subprime mortgage defaults were ticking up. The warning signs were there for anyone willing to look. Yet, the overwhelming mood in the market and in the public consciousness right through the middle of 2007 was one of supreme confidence. The stock market was hitting all-time highs. The CEO of one of the largest financial institutions on Wall Street famously said in mid-2007 that, "As long as the music is playing, you've got to get up and dance." This single quote perfectly captures the psychological state of the market. It was a party, and nobody wanted to be the one to leave early. This is a classic example of what is known as narrative economics, a concept championed by Nobel laureate Robert Shiller. The dominant narrative of the mid-2000s was that housing prices could never fall on a national basis. This story was repeated so often by real estate agents, mortgage brokers, financial news anchors, and even government officials that it became an article of faith. It was a simple, powerful, and comforting story. It allowed people to justify taking on enormous mortgages and allowed banks to justify creating and selling ever riskier mortgage-backed securities. The narrative became more powerful than the underlying data. The rising interest rates were just a footnote, a minor detail that was easily dismissed because it didn't fit the prevailing story. Warren Buffett during this time was conspicuously quiet and cautious. Berkshire Hathaway was sitting on a mountain of cash. He wasn't buying the big banks or the mortgage companies that were the darlings of Wall Street. He wasn't participating in the dance. In a 2007 letter to shareholders written before the worst of the crisis hit, he spoke about the dangers of leverage and complex derivatives. He famously called them, quote, financial weapons of mass destruction. He wasn't reacting to a specific data point, he was reacting to a change in the overall environment. He saw that the combination of rising interest rates and the explosion of household and financial sector debt was a recipe for disaster. He saw a system that had become incredibly fragile and was being subjected to increasing stress by the Fed's tightening policy. While everyone else was focused on the beautiful music of the narrative, Buffett was listening to the ominous creaking of the ship's hull. His ability to ignore the seductive power of the prevailing story and focus instead on the fundamental risks is a testament to his psychological discipline. When the music finally stopped in 2008, the dancers were crushed. Buffett, with his pile of cash, was one of the few people in a position to step in and buy assets at bargain basement prices, famously making lucrative investments in companies like Goldman Sachs and General Electric when they were on the brink of collapse. The psychological principle that drives this dangerous groupthink is normalcy bias. This is our brain's natural tendency to assume that the future will look very much like the recent past. It's a cognitive shortcut that is useful in our daily lives. We assume the sun will rise tomorrow because it always has, but it is catastrophic in the world of finance, which is characterized by cycles and paradigm shifts. During a long period of economic stability and rising asset prices, like the one from the early 90s to 2007, with the brief interruption of the dot-com bust, our brains become conditioned to this environment. We start to believe it is normal and permanent. The idea of a severe, system-wide crisis becomes almost unthinkable. Normalcy bias is what allows a homeowner in 2006 to stretch and buy a house at the peak of the market, assuming that real estate values will continue their gentle upward climb forever. It's what allowed a bank CEO to lever up his firm's balance sheet 30-1, because the risk models, all based on the normal data of the recent past, told him it was safe. This is amplified by a phenomenon known as motivated reasoning. This is our tendency to conform our assessment of information to a conclusion that suits our own interests or desires. Everyone involved in the housing bubble had a powerful motivation to believe the, quote, housing never goes down narrative. The homeowner wanted to believe their biggest asset would only increase in value. The mortgage broker wanted to believe the loans they were writing were sound, so they could keep earning commissions. The investment banker wanted to believe the mortgage-backed securities they were creating were safe, so they could keep collecting fees. This creates a collective state of denial. Any information that threatens the profitable narrative, like the data on rising defaults or the fact that the Fed was hiking rates, is dismissed, rationalized away, or ignored. It's not necessarily a conscious conspiracy, it's a subconscious, self-serving alignment of beliefs. Buffett's approach is a direct assault on normalcy bias and motivated reasoning. His study of financial history has taught him that crises are not black swan events. They are a normal, recurring feature of the capitalist system. He knows that periods of excess and leverage, fueled by easy money, always end badly. His mental model is not based on the assumption of a stable future but on the certainty of cycles. Furthermore, his financial independence and the structure of Berkshire Hathaway insulate him from motivated reasoning. He doesn't need to believe in a narrative to earn a fee this quarter. His only goal is the rational allocation of capital for the very long term. This allows him to maintain an objective, almost clinical detachment. While the rest of the market is caught in a psychological vortex of normalcy bias and motivated reasoning, he is able to calmly assess the shifting probabilities and position his capital accordingly. He is playing a different game, one governed by logic and history rather than emotion and incentives. To protect ourselves from these powerful psychological tides, we need a practical mental model. Let's call it the narrative inversion technique. It's a simple three-step process for stress testing the dominant market story and seeing the world from a more contrarian and rational perspective. Step 1. Clearly identify the dominant narrative. At any given time, there is a prevailing story that everyone seems to believe. In 1999, it was the new economy. In 2007, it was, quote, housing never goes down. In 2021, it was the Fed has our back, and software is eating the world. The first step is to simply articulate this story as clearly as possible. Write it down. What is the one belief that, if it turned out to be false, would cause the most damage to the current market structure? Often you can find this narrative repeated ad nauseum on financial television and in the headlines of popular investment websites. Step 2. Actively search for disconfirming evidence. This is the most crucial step and requires a conscious effort to fight your own confirmation bias. Your brain will want to find evidence that supports the dominant narrative. You must force it to do the opposite. If the narrative is that housing prices will rise forever, your job is to find data on household debt levels, affordability metrics, and default rates. If the narrative is that a certain technology is the future, your job is to study the historical failure rates of new technologies and the competitive landscape. A key piece of disconfirming evidence is almost always the actions of the Federal Reserve. Is the Fed's policy supportive of the narrative, lowering rates, or is it actively working against it, raising rates? A narrative that requires low interest rates to be true is incredibly vulnerable when the Fed is tightening policy. You are essentially looking for the pin that could pop the bubble. Step 3. Construct the bear case and assign it a probability. Now, based on your disconfirming evidence, write out the opposite story. This is the bear case, or the inversion of the dominant narrative. For 2007, the inverted narrative would be, rising interest rates and unaffordable prices will cause the housing market to crash, which will lead to a wave of mortgage defaults, which will bankrupt the over-leveraged banks that own these loans, causing a systemic financial crisis. After constructing this story, try to assign a non-zero probability to it. Even if you think it's only a 10% or 20% chance, the act of seriously considering it changes your entire perspective. It forces you to acknowledge the risks that the herd is ignoring. A portfolio manager who assigned even a 10% probability to a systemic crisis in 2007 would have taken defensive measures, reducing leverage, selling vulnerable stocks, perhaps buying some portfolio insurance that would have saved them from catastrophic losses. This narrative inversion technique is a powerful tool for developing the second level, contrarian thinking, that is the hallmark of every great investor. The path of the 99% is to blindly accept the dominant narrative without question. It is the path of least psychological resistance. It feels good to agree with the crowd. It's comforting to believe in simple, optimistic stories. The antithesis of narrative inversion is what we can call narrative surrender. This is the passive consumption of financial media and the adoption of the prevailing mood as your own. The investor who engages in narrative surrender outsources their thinking to others. Their opinion on the market is simply a reflection of the last headline they read or the last pundit they heard on TV. In 2021, the narrative was one of endless innovation and growth. Stories of cryptocurrencies, NFTs, and disruptive tech companies dominated the conversation. People who had never invested before were opening brokerage accounts and pouring their life savings into the most speculative assets imaginable, all because they had surrendered to the narrative that this was the path to quick and easy financial freedom. They were not performing any fundamental stock analysis. They were buying the story. They ignored the flashing red warning sign that the Federal Reserve was openly discussing the need to raise interest rates to combat the highest inflation in 40 years. The narrative of tech utopia was simply too compelling, and the disconfirming evidence of a hawkish Fed was too boring and unpleasant to consider. The consequences of narrative surrender are always the same. The narrative-driven investor buys high, caught up in the euphoria, and sells low, overcome by the terror, when the narrative inevitably breaks. They are perpetually whipsawed by the market's emotional cycles. They are the dumb money that provides the liquidity for the smart money, like Buffett, to execute their contrarian strategies. The path of the 99% is characterized by a complete lack of an independent analytical framework. They are emotional reactors, not rational actors. This is why the vast majority of retail investors tragically underperform the market over the long run. They are not defeated by a lack of intelligence or information, but by a failure of psychological discipline. They surrender to the story instead of doing the hard work of questioning it. The direct financial connection of this psychological battle is the transfer of wealth from the emotional to the rational. Market manias and panics are the mechanisms by which this transfer occurs. During a narrative-driven bubble, like the dot-com boom or the 2021 growth stock mania, the financial impact is the creation of vast amounts of ephemeral, on-paper wealth. People see the balances in their retirement and brokerage accounts swell to levels they never thought possible. This creates a powerful wealth effect, encouraging them to spend more and save less, feeling secure in their newfound fortune. However, this wealth is not real. It is a phantom, built on a foundation of unsustainable valuations and a flawed narrative. When the narrative breaks, usually triggered by a shift in Federal Reserve policy, the crash happens. This is where the wealth transfer occurs. The investors who surrendered to the narrative, who are overinvested in the most speculative assets, see their paper fortunes evaporate. They panic and sell at the bottom, crystallizing their losses. Who is buying from them? The rational, disciplined investors, the Buffetts of the world, who resisted the narrative, preserved their capital, and are now using that capital to buy wonderful assets at deeply discounted prices. The wealth doesn't just disappear, it changes hands. It moves from those who were controlled by the market psychology to those who understood it. This is the engine of long-term outperformance for any value-oriented, contrarian investment strategy. The financial returns are a direct harvest of the psychological mistakes made by the crowd. This is why developing a strong psychological fortitude and an independent framework like narrative inversion is not just a matter of good practice. It is the absolute key to successful long-term investing. Without it, you are destined to be part of the 99% who consistently buy high and sell low, funding the superior returns of the disciplined minority. Your personal financial independence quite literally depends on your ability to win this internal psychological battle. This brings us to our fifth and final pillar. We have dissected the theory of financial gravity from every angle: mathematical, economic, and psychological. Now we must synthesize this knowledge into a coherent investment strategy. How do we actually use this principle to build a portfolio that can withstand the immense pressures of a high-interest rate environment? This is where we uncover Buffett's defensive moat. It is a strategy built not on predicting the future, but on preparing for it. It is about identifying and owning businesses of such exceptional quality that they can not only survive but actually strengthen their competitive position when financial gravity intensifies. The perfect anecdote to illustrate this principle is not a single transaction but a long-standing and defining feature of Berkshire Hathaway's portfolio: its massive, multi-decade investment in the Coca-Cola Company. Buffett first made a substantial investment in Coke in 1988, eventually acquiring a stake worth over $1 billion, a huge sum for Berkshire at the time. This was not a trade, it was the purchase of what he considered to be a permanent holding. To understand why Coke is the quintessential defensive moat company, we must analyze it through the lens of a high-interest rate world. Imagine the Federal Reserve has raised interest rates to 7% to fight runaway inflation. The economy is slowing down, and consumers are tightening their belts. How does a business like Coca-Cola fare in this hostile environment? First, let's apply our corporate stress test. Does it have a lot of debt? No. Coca-Cola has historically maintained a very strong balance sheet with manageable debt levels. It is not at risk of being crushed by rising interest expenses. Second, is its business cyclical? No. It is profoundly defensive. People do not stop drinking Coke during a recession. It is an inexpensive, habitual purchase. While they might cut back on buying a new car or a luxury vacation, the daily pleasure of a cold soda is one of the last things to go. Its revenues are incredibly stable and predictable. Third, and most importantly, does it have pricing power? Absolutely. This is the core of its moat. The brand Coca-Cola is one of the most powerful in human history. It evokes feelings of happiness and nostalgia. If the cost of aluminum cans, sugar, and transportation goes up due to inflation, Coca-Cola can pass those costs along to the consumer by raising its prices by a few pennies. Its customers will barely notice, and they certainly won't switch to a generic store-brand cola to save a nickel. This ability to protect its profit margins from inflation is an invaluable asset in a high-rate environment. Now, consider the broader implications. In this 7% interest rate world, capital is expensive. It is difficult for new competitors to emerge. Who could possibly raise the billions of dollars in advertising and distribution infrastructure needed to challenge Coca-Cola's global dominance when the cost of capital is so high? A high-rate environment actually strengthens Coke's competitive position by making it harder for anyone to attack its moat. Furthermore, the company itself requires very little capital to grow. It doesn't need to build massive, expensive new factories every year. It can grow by simply selling more syrup concentrate, an incredibly high-margin business. This means it generates enormous amounts of free cash flow. In a world where capital is scarce and expensive, a business that gushes cash is king. This is the essence of Buffett's strategy. He is not trying to find companies that will do well when interest rates are zero and money is free. Any fool can make money in that environment. He is looking for businesses that can thrive when conditions are difficult. The defensive moat of a company like Coca-Cola, its brand, its distribution network, its low capital intensity, and its pricing power, allows it to sail through the storms of high interest rates and economic recessions that sink more fragile, leveraged, and cyclical businesses. His investment in Coke was a bet on enduring business quality, a quality that becomes most apparent and most valuable precisely when the gravitational force of high interest rates is at its peak. This is the blueprint for building a portfolio that is not just resilient but anti-fragile. The underlying psychological principle that allows Buffett to focus on these types of businesses is his remarkably long time horizon, a trait that is exceedingly rare in the modern financial world. The cognitive bias he is overriding is known as hyperbolic discounting, or simply present bias. This is our brain's strong tendency to prefer smaller, immediate rewards over larger, later rewards. It's the reason we choose to eat a donut today rather than stick to a diet for the long-term benefit of better health. In investing, this bias manifests as an obsession with short-term performance. The average investor, and even many professional fund managers, are fixated on this quarter's earnings, this year's stock performance. They are playing a short-term game. This leads them to favor companies that can deliver exciting, immediate growth, even if that growth is low quality and funded by unsustainable debt. The business model of a high-flying, unprofitable tech company is perfectly suited to appeal to our present bias. It offers the thrilling promise of rapid, exponential gains right now. The slow, steady, predictable profit growth of a company like Coca-Cola seems boring and unappealing by comparison. It offers a larger, more certain reward far in the future, which our hyperbolically discounting brains struggle to value properly. Buffett's entire investment philosophy is a rebellion against this short-termism. His preferred holding period, he famously says, is forever. This incredibly long time horizon completely changes his decision-making process. He is not asking, what will this stock do in the next 6 months? He is asking, will this business still be dominant and profitable in 20 or 30 years? This long-term perspective forces him to prioritize business characteristics that endure through economic cycles. Factors like brand loyalty, network effects, and low costs, the components of a durable moat, are far more important than a single quarter's revenue growth. A durable moat is a feature that provides value over decades. A temporary surge in demand caused by a fad or a government stimulus program is, by definition, fleeting. By consciously adopting an extremely long time horizon, Buffett forces himself to ignore the short-term noise and focus only on the long-term signal of business quality. He is not trying to get the immediate gratification of a hot stock tip. He is seeking the profound, delayed gratification of compounding his wealth in superior businesses over a lifetime. This is a psychological discipline that is simple to understand but incredibly difficult to practice in a world that bombards us with constant information and demands immediate results. It is perhaps the single greatest psychological advantage an investor can possess. So how do we translate this into an actionable blueprint for our own portfolios? We can create a final mental model called the moat identification system. It is a framework for analyzing a business to determine if it has the kind of durable competitive advantage that can withstand the pressures of a high-interest rate world. It consists of 4 key questions. First, is this a business I can understand? This is Buffett's famous circle of competence rule. He avoids businesses with complex technologies or rapidly changing industries because he cannot confidently predict their long-term future. A business like Coca-Cola or See's Candies is simple. Its product and its appeal are timeless. By sticking to simple, understandable businesses, you are better able to assess the durability of their moat. If you can't explain to a 10-year-old how the business makes money and why its customers will still be there in 10 years, you should probably avoid it. Second, does the business have favorable long-term economics? This is where you look for the signs of a moat. High and consistent profit margins are a key indicator. A company that consistently earns high returns on the capital it employs is likely doing something its competitors cannot replicate. You should also look for a business that does not require huge, constant capital expenditures to maintain its position. A railroad needs to spend billions every year just to maintain its tracks, while a software company with a dominant platform can grow with very little incremental capital. This capital-light nature is a massive advantage, especially when capital becomes expensive. Third, is the management team able and trustworthy? Even a great business can be ruined by poor management. Buffett looks for managers who are honest, rational, and act with the long-term interests of the shareholders in mind. A key test is to look at their capital allocation decisions. Do they wisely reinvest profits back into the business, make smart acquisitions, or return capital to shareholders through dividends and buybacks? Or do they squander it on overpriced empire-building acquisitions and lavish executive perks? Reading a CEO's annual letters to shareholders for the past decade is one of the best ways to get a sense of their character and competence. Fourth, is the stock available at a reasonable price? This is the final and critical step. Even the best business in the world can be a terrible investment if you overpay for it. This brings us full circle back to our first pillar. Your assessment of a reasonable price must be made in the context of the current interest rate environment. A P/E ratio of 25 might seem reasonable when interest rates are 1%, but it could be wildly expensive when rates are 5%. You must use your hurdle rate compass to determine if the expected return from buying the business at its current price is sufficient to compensate you for the risk, given the safe return you could get from a government bond. The goal is not just to find great companies, but to find great companies trading at prices that offer a margin of safety and a prospective return that clears your hurdle rate. This 4-step system provides a disciplined, repeatable process for building a portfolio of high-quality, resilient businesses, a true defensive moat for your capital. The antithesis of building a defensive moat is the strategy of renting, not owning. The 99% of market participants who fail over the long term are not investors in the true sense of the word. They are renters of stocks. They are temporary holders, speculators, who are simply betting on short-term price movements. They have no interest in the underlying business, its management, or its long-term competitive position. Their entire focus is on the stock's chart pattern, the latest news catalyst, or the hot narrative of the day. This approach leads to a portfolio of low-quality, highly cyclical, and often over-leveraged businesses that are exquisitely sensitive to changes in the economic environment. A portfolio built by a renter is often a collection of the most popular and exciting stocks of the moment. In 2021, this would have been the meme stocks, unprofitable tech companies, and speculative cryptocurrency-related firms. These companies had no moats. In fact, Many were burning through cash at an alarming rate, their very survival dependent on their ability to continually raise new capital in a low-interest rate environment. The renter is not concerned with this. Their thesis is not, "This is a wonderful business that will generate cash for decades." Their thesis is, "This stock is going up and I can sell it to someone else for a higher price next week." This is the greater fool theory of investing. The disastrous consequence of this approach is that it leaves the portfolio with absolutely no defense when financial gravity returns. When the Fed raises rates, the game changes completely. The supply of cheap capital that was keeping these speculative businesses alive dries up. The economic slowdown crushes their cyclical revenues. They have no pricing power to combat inflation. They have no durable moat to protect them. The renter's portfolio is a house of cards built on a foundation of easy money. And a shift in monetary policy is the gust of wind that blows it all down. The renter is then forced to sell in a panic, often losing most of their initial capital, and vows never to invest in the stock market again, blaming their misfortune on a rigged game rather than their own flawed strategy. They failed because they were focused on renting stock tickers instead of owning businesses. The ultimate financial connection of Buffett's defensive moat strategy is the power of long-term compounding. This is the true engine of building wealth. The renter's portfolio, with its boom and bust cycles, never allows compounding to work its magic. A portfolio that gains 50% one year and loses 40% the next has a net return of negative 10% over 2 years. The volatility destroys the returns. A portfolio built on a foundation of defensive, high-quality businesses like Coca-Cola aims for a different path. It may not capture the full upside of a speculative mania, but its primary goal is to avoid the catastrophic drawdowns that wipe out years of progress. Let's quantify this. Imagine a portfolio of moat-protected businesses that delivers a steady, if unspectacular, 10% annualized return. A $100,000 investment, left untouched, would grow to over $670,000 in 20 years. After 40 years, it would be worth over $4.5 million. This is the eighth wonder of the world, as Einstein is said to have called it. The key is the uninterrupted nature of the compounding. By avoiding the 50% or 60% losses that a renter's portfolio experiences every few years, the defensive moat portfolio keeps its capital base intact, allowing the compounding engine to run smoothly year after year, decade after decade. This is the financial transformation that this entire framework promises. By understanding financial gravity, you learn to avoid the speculative manias that lead to catastrophic losses. By focusing on building a defensive moat of high-quality companies, you create a portfolio that can withstand economic storms and continue to compound wealth through good times and bad. This is the shift from a get-rich-quick mentality to a get-rich-surely strategy. It is the path Warren Buffett has followed to become one of the wealthiest people on the planet. It is not about genius-level stock picking or complex market timing. It is about a profound respect for a few timeless principles. Understand the environment, demand a margin of safety, focus on business quality, and let the power of compounding do the heavy lifting. This is the final and most powerful connection between an abstract principle like financial gravity and the tangible, life-altering goal of achieving true and lasting financial independence. You have just invested a significant amount of your most valuable asset, your time, to rewire the way you see the financial world. You should feel an immense sense of accomplishment. You have moved beyond the superficial noise of the daily market chatter and have grasped a fundamental law of the financial universe. You now possess the mental tool that Warren Buffett calls financial gravity. You understand that interest rates are not just a boring economic statistic. They are the force that governs valuations, dictates the flow of capital, and separates strong businesses from weak ones. You can now look at any market environment, at any company, at your own portfolio, and see the invisible tethers of this force at play. This knowledge is a permanent upgrade to your decision-making software, a powerful lens that will protect you from the single most costly mistake in investing, getting caught on the wrong side of a major shift in the economic climate. But here is the crucial next step. Understanding the law of gravity is one thing. It's the essential foundation that protects you from crashing. However, the true path to exceptional portfolio growth and building lasting wealth lies in the next level of this knowledge. It's about learning how to identify and build the financial equivalent of a spacecraft, a business so powerful with a competitive moat so deep that it can almost defy gravity. Knowing that high interest rates are a headwind is defensive knowledge. Knowing the specific characteristics of a business that allow it to accelerate and gain market share because of that headwind is offensive, wealth-building knowledge. The framework we've discussed today is the map of the gravitational field. The next piece of the puzzle is the blueprint for the rocket ship. The video that is now appearing on your screen is not just another video, it is the missing link. It is the bridge between the macro understanding you have just mastered and the micro-level skill of identifying these gravitational escape artists. It takes the principles we have laid out and shows you how they manifest in the real world, in the balance sheets and income statements of the world's most dominant companies. The journey from being a retail investor to developing a true CEO mindset is a process of assembling a complete mental arsenal. You have just forged the shield. The next step is to forge the sword. Most people will stop here, content with understanding the problem. But the intelligent investor, the entrepreneur, the person truly committed to their financial independence, always seeks to master the solution. The choice to continue this ascent, to complete your understanding and learn what separates a good company from a truly great one, is yours. The next piece of that map is on your screen now.